I'm Sidhartha Das, a Sid Dash from Chartis Research, and today I'm going to today we're going to have today we're going to have our conversation around uh, what risk tools do buy-side asset managers need for current and future investments. And I'm going to be joined by Luke Armstrong from S&P Global Market Intelligence. Luke, could you just introduce yourself?
Hey, Sid. Hey, everyone. Great to be here again. My name's Luke Armstrong, and I'm the head of BuySide risk at S&P Global Market Intelligence.
Thanks, Luke. Uh, Everyone, sorry, a little bit about our sequencing, and but with that, let's dive into the details of the areas that the areas of this diverse buy side environment, which includes different types of asset managers, hedge funds, credit funds, and real estate funds and private equity funds, if you will. This this diversity. What can we say for certain? And I think some of the themes that we can say for certain are: A, regulations will increase, and the reporting requirements will continue to increase, because we know that the regulatory environment for asset managers and buy side firms in general is relatively light compared to the regulatory environment that you see for large sell side firms. But steadily, both the reporting and regulatory environment driven has been getting more complex. You started to see things such as liquidity risk management requirements, such as Rule 23E4. You started to see things such as threshold reporting, Form PF, and then there are, of course, the proposed SEC regulations and derivatives. There's been significant focus on transaction reporting from MiFID. So with that, you're starting to see an environment where you're seeing more increase in regulatory and risk reporting. But the big one is climate risk. Look, would you care to comment on that?
Yeah, absolutely. Thanks, Sid. I mean, the world is really witnessing the tangible consequences of climate change. We're starting to see physical risk devalue company assets, and the measures to transition to a low carbon economy are going to start influencing our financial landscape. And as those shifts occur, what we're seeing and what we're going to see more of is how asset allocation will start to change. Maybe carbon intensive companies and sectors may start to see decreased investment as investors start to seek out more sustainable alternatives. And then regulatory initiatives, as you've said, Sid, aimed at enhancing transparency and sustainability investing are really compelling buy-side firms to take climate risk more seriously. But in the long term, what we've seen, allocating risk to climate-friendly issuers can sometimes have an impact on returns. Putting it into context with the Russia-Ukraine conflict, energy companies saw some huge short-term profits whilst green businesses were struggling. And some buy-side firms were even scrutinized for not putting investor interests first in that context. But what we really must recognize from the conflict in terms of lesson learned is how to develop alternatives to fossil fuels for long-term sustainability. And we really need to embrace sustainability as a fundamental factor in investment decision-making processes. And what we need risk teams to be able to do on top of that is challenge and monitor that. Over the last few years, we've seen limits imposed on funds based on exposure to ESG scores, but taking that to the next level and integrating sustainability into the investment risk process is the next step that we are helping customers get to. But there's issues around that, correlations between ESG credentials and changes in ESG credentials relative to credit spreads can be weak. which can make it challenging to directly observe how the sustainability practices of a given issuer can affect the price of its securities. But generally, what we see is that the market sentiment, when focusing on the environmental aspect of the ESG score, investors tend to favor companies that have good environmental, frameworks. Passing it back to you, Sid, whilst climate risk is a relatively new trend, what we've witnessed over the last sort of decade or so is how alternative assets and derivatives usage has increased over this sort of period of low rate environment.
Of course. I mean, the analytical foundations and the challenge and the modeling issues around climate risk, as you rightly said, are going to be a long-running issue. However, what we have seen over the last decade or so is the huge shift, a huge shift towards alternative assets generally, but alternative credit specifically, where we have seen substantial shift away from the banking environment to a variety of new or newish fund structures, all credit. We have seen insurance companies expand their portfolio, and then as we see that, and in many geographies, we've already seen the credit origination sort of from the asset side cross over the 50% mark. So we're seeing a very deep structural change in the credit and credit intermediation sort of space, if you will. Meanwhile, we have also seen the growth of derivatives, where asset managers are using standard interest rate and other derivatives to fine-tune their strategies, change their risk profile, change their interest rate profile. And a lot of that was sort of driven by the fact that we had a low interest rate environment and you needed a higher yield. A lot of this is going to be challenged. We're not going to go back in time where the whole credit intermediation universe that has taken shape is going to disappear. That's not going to happen. We're not going to see complete re-intermediation away from the banks. But what we're going to see is structural challenges as significant credit sectors come under stress. And that's going to be an interesting phenomenon. How do you value these securities? How do you take them into your standard portfolio construction mechanism? And how do you risk manage and risk attribute? All of this is going to be a significant challenge as the interest rate dynamics change and we see more interest rate volatility. This brings me to the sort of last significant issue for which we definitely are certain, and that is the fact that in this higher rate environment, we're going to see more focus on liquidity. Luke, would you care to comment on that?
Yeah, absolutely, Sid. I mean, as you've mentioned already, buy-side firms have really increased their exposure to liquid assets, such as private equity, private debt, but also, as you said, derivatives over the last decade to try and seek those returns in a low-rate environment. And as you said, unwinding over that sort of asset allocation isn't going to happen overnight. But as we find ourselves in this increasing rate environment, the confluence between interest rates and liquidity risk is more apparent, obviously. Private asset valuation, which generally tends to have a lagged response to public market drawdowns, are now being marked down. And these circumstances can lead to significant changes in liquidity profiles for funds, with increased exposure to less liquid asset types. And these liquidity profiles start to become unsustainable when we consider events like the LDI crisis last year, when funds have to navigate heavy redemptions in a very short time frame. If they're holding a bunch of liquid assets in their books, it's just not going to happen in the time frame that you need to be able to react in that sort of situation. So, even when you're investing in less liquid securities, you're facing redemptions or fire trading. Applying a waterfall trading approach, selling your most liquid assets first can really significantly affect the liquidity profile of a fund in the long term. And so just generally, the current environment of high inflation, increasing rates, quantitative tightening, higher volatility has really resulted in thin liquidity for money managers. So caution needs to be exercised. One underestimated risk can quickly escalate and lead to big problems.
Thank you. So that actually brings us to what do we know for certain? These are key structural themes that we think are going to affect everyone and is broadly going to impact the overall buy side, regardless of the particular type of fund or asset manager that you happen to be. Now, what does that result in? In our view, in my view, it results in a few key issues. Liquidity risk models being under greater scrutiny. And as you talked about the focus on climate risk, that means greater focus on climate scenarios, greater demands on technology and, of course, the data infrastructure, and finally, collateral and marginalities. But with that, back to you, Luke, on some issues around some of these results, if you think, and how do you see them evolving?
Yeah, thanks, Sid. I mean, the liquidity risk models have gone through evolution sort of over the last 5 to 10 years. They're becoming, and it's becoming even more crucial to try and anticipate and account for potential liquidity challenges, particularly in a challenging market environment. And that's where risk teams really need to come in, incorporating the interplay between rates, liquidity, and market dynamics into liquidity models will really help investment teams, will enable risk teams to help investment teams make informed decisions and navigate potential challenges. And on the climate scenario front, the key is to incorporate the impact of climate risk on a short-term horizon. So what we're focusing on is helping risk teams being able to model short-term impacts of climate changes on portfolios, which will enable them to start challenging portfolio managers from a sustainability perspective. And by sort of encouraging that collaboration between risk teams and portfolio managers for non-classic sort of market risk factors, starting to talk about liquidity and climate risk more in that conversation between risk teams and portfolio managers is what we're helping our customers do. And it's the key to better understand and help navigate the challenges presented by both liquidity and climate change. And underpinning all that is technology and data. We all know that risk teams are becoming more quantitative, more data inquisitive, and they need the tools to be able to really start challenging investment teams from all aspects, not just market risk, liquidity risk, but also climate risk, the new one coming up. That's the key, is the technology behind being able to do that, and obviously all of the data.
No, of course, the clearly with greater demands on liquidity, new data sets for climate scenarios, and there is a clear demand for greater technology depth and greater data depth. Fortunately, in some ways, the technology environment itself has changed. We now have a wide range of, if you look at the physical substrate, besides applications which have grown, obviously, but if you look at the physical substrate has a much more flexible environment. The cloud infrastructure has allowed vendors and asset managers and buy-side firms to leverage their grid more easily. Equally, there's been significant innovations in the way you can manage and hold large and complex data sets. So overall, we think overall, in some ways, the technology is available if you can leverage it. And lastly, there is this for particularly if you're a significant user of derivatives, there is the potential driver and requirement to ensure that you know and how you're managing your collateral, how you're managing your margin requirements, and again, there's a broad pool of tools to enable you to do that. So, so as we can see, there are major structural themes that are changing the way the buy side needs to respond. Right, starting from regulations to climate risk, and obviously the changing macro environment, and with that, um, you know, we'll be sort of coming to a close. Luke, any final comments before we close our conversation today?
No, I mean, I think we covered the key points in the time that we've had, and yeah, as you said, it's about leveraging the technology and the tools to be able to start taking advantage of the tech that's out there to be able to embed these new risk factors into the investment risk process.
Thank you. Thank you, Luke, for being here for our conversation and discussion. I think we hopefully brought out some of the key drivers and sort of the key responses, if you will. With that, we bring our conversation to a close today.
Thank you very much.